Now, in order to plan for a future where you're going to be dependent on something, you need to create something that you can depend on, right? So when you're working, if you can scrape away a little bit of your leftover income, and if you can invest it the best you can, you know that there's going to be a pot of money left over afterwards, which will supplement your years where you're not able to work. For some people, that's not possible. The New Zealand Super Fund, which was set up in 2001 by an act of legislation, is designed to help fund the government's obligation to pay us what effectively is a universal basic income from the age of 65 onwards. Today, I'm catching up with Rishabh Sethi, who manages third-party managed investments and also chairs the investment committee. I'm talking to him about how the New Zealand Super Fund is different from an international perspective, how it's managed to outperform most indexes. And I'm also talking to him about the most important question, I think, on everybody's minds at the moment. When will they start getting exposure to Bitcoin? The answer might surprise you. Now, if you're new here, please like and subscribe. Let's get started. Hey, welcome everybody, and thank you for joining us on the Everyday Investor Podcast. Today, I'm catching up with Rishabh Sethi at the NZ Super Fund. How are you, Rishabh?
Very well, Darcy. Thanks for having me.
Can you just give us a bit of a backstory around how you ended up working with the NZ Super Fund?
Sure. I have a sort of like an educational background in economics and maths. So I started my career at the Reserve Bank down in Wellington. Later on, came to the New Zealand Super Fund predominantly to build some models and write some code. Headed off overseas for a few years, and then when it was time to kind of like come back home to New Zealand, was sort of like looking around for for investment management. I think that's been of main interest. So I've just ticked over 10 years now at the New Zealand Super Fund.
What kind of occupies most of your day?
With our team, I'm responsible for implementing all of our externally managed equities, credit strategies, and sort of like our alternatives as well. So within that alternatives bucket, one might put hedge funds and insurance strategies and other, so-called liquid alternative investments as well. So a large part of the day is either thinking about new investments, new people, new ideas that we want to work with. So there's a lot of research, I guess, that's happening. There's also thinking about the structure of new investments. So when we like an idea, how do we actually, what's the best way of accessing that idea?
Right.
There's usual ongoing monitoring of the existing stuff that you have in your portfolio. And then occasionally one might actually have to have like a difficult conversation with someone because something isn't going particularly well, or you have questions about how things are doing. So that's, I guess, part one of the job. Part two is I also chair our investment committee. There's a little bit of time sort of like spent thinking about, how best to structure the investment committee's time, what kinds of decisions it should be focused on, and just thinking about governance, investment governance in general.
Okay. And well, I want to come back to just how the investment decisions are made and the structure of it, because to me, it kind of sounds really analogous to how KiwiSaver works or any other managed fund works in a way, but
Yeah.
there's one heck of a twist. So let's start off with some rather beginner questions, I guess you could say. But knowing that I am kind of just, I'm
Yeah.
really keen just to really fully understand these fundamentals as well. So let's start with the obvious question, which is, what is the NZ Super Fund?
Yeah, sure. In New Zealand, as I think people might know, there is government guaranteed, crown guaranteed national superannuation, and that's available to everyone above the age of 65. Now, that's effectively a pay-as-you-go system, which means that each year's expense that the Crown incurs on national super is paid from that year's tax collection, right? Now, that's all well and good, but obviously, with the population aging over time, the expectation really is that vastly more people will become eligible for national super over time. and there will actually be fewer taxpayers proportionally to help fund that. So this demographic problem, I think, was apparent a very long time ago. So in 2001, under the Labour government at that time, they passed an act which kind of like set up this particular institution. And the goal of the institution is to basically help the government pre-fund some of the future expense that they will have on paying for superannuation. So 2003 was in September 2003, the fund started investing its first dollar. So we just hit our 20-year anniversary in September last year.
Mm, that's cool. And so the whole idea here, I guess, is that right now, so New Zealand government will be paying these superannuation payments to people over the age of 65, so long as they meet the eligibility criteria. Due to demographic changes over time, we're probably going to have a lot more people, not probably, we will have a lot more people receiving those payments in the future than the amount of tax that's being collected. And so this trend was spotted a while back, and Michael Collin came up with the idea, or under his leadership, the New Zealand Super Fund got started. And so at the moment, the superannuation payments, they come directly from the government right now, right? They're not necessarily drawing on the New Zealand Super Fund. Is that correct?
That's right. Yeah. We receive contributions from the government. We are not paying back, or there are no withdrawals from the fund for now. There's a funding formula that sort of like determines what that is. So they will start in to a small degree in sort of like the mid 2030s. But the real thrust of sort of like, the New Zealand Super Fund's efforts to pay for national super probably won't be felt maybe until the late 2040s, early 2050s, and then it'll keep growing really over time as well. We do make some payments to the Crown, but they're predominantly tax payments, just depending upon how things are going. So in some years, we have been New Zealand's largest corporate taxpayer.
Yeah. I read about that, and I find that quite fascinating that the New Zealand Super Fund actually has to pay tax in New Zealand. I found that fascinating to begin with. And I guess it is kind of like a form of withdrawal, sort of, isn't it? And it kind of offsets the fact. So the amount that the government is contributing towards the New Zealand Superannuation Fund, is that a constant amount that they contribute no matter what? Is that paused over time? Can you give me a little bit of a lowdown as to where the money, or how the money gets into the New Zealand Super Fund?
Yes, so there is a funding formula in the Act that kind of like determines how much the Crown should be funding the New Zealand Super Fund by each year. Basically, the better we do performance-wise, the less funding has to be provided into the New Zealand Super Fund in terms of the formula. Of course, the government retains the right to suspend those contributions. And so that did actually happen in the aftermath of the global financial crisis between 2009 and 2017. And that's when contributions restarted.
And so I was reading something here. It's around about $2 billion per year is roughly being contributed.
Approximately. Yeah, that's right. Yeah.
It's quite interesting, isn't it? Like, I think if you bring this down to a household level, we want to prepare for our retirement. So putting superannuation aside that we get from the government, if we want to prepare for an even better retirement, we want to contribute as much of our income as we can during our working lives, with the intention that we are going to stop contributions at some future point because our income stops. And then we start drawing down on that resource that we built up. And subject to the rate at which we withdraw it, we can either preserve some of that capital that's been built up, or we can deplete it. And so is that kind of similarly the idea here with the super fund, is that we're trying to build it up to a certain amount so that we can withdraw some amounts without depleting the underlying capital? Is that kind of the idea?
That's absolutely right. The model is very similar. The only difference is that at a personal level, it is, today's you that is trying to pay for the future you. However, at the national level, at the New Zealand Super Fund level, at the National Superannuation Fund level, it's today's taxpayer who's paying for today's retiree. we're trying to pre-fund some of those future obligations.
And the intention isn't to fully replace or fully let the government off the hook in terms of taxpayer payments in the future, is it? Or is the New Zealand Super Fund only really going to replace a portion of that future liability?
I think it's important to note that the liability for paying super rests solely with the Crown. So that's not an explicit part of the New Zealand Super Fund's mandate. But yeah, so it's the liability sits with the government. Our job at the New Zealand Super Fund is to try and deliver as much return as we possibly can back to the Crown. And the better we are able to do the job, the easier it is for the Crown to meet its obligation, and commensurately, the lower the burden on future taxpayers as well.
Okay. So
But you are quite right. Under the way that the formulas are set up and the way that the current funding arrangements are set up, the withdrawals in the future from the New Zealand Super Fund will not be enough to meet future retirement income obligations that sit with the Crown.
okay.
They'll just pay for a portion of that.
So they hold that obligation. They're ultimately the ones that hold it. And the NZ Super Fund is just the vehicle that will help the Crown. It's just one of the mechanisms that's being used to be able to meet this rising demand and
Absolutely. Yeah.
obligations. So how does like what else can you tell me about the mandate and how do you achieve that mandate?
I actually think the legislation as a whole that set up the New Zealand Super Fund is actually one of our real endowments. If I look at whatever successes the New Zealand Super Fund might have enjoyed over the past couple of decades, a lot of it actually comes down to the legislation itself. The
Hmm.
fact that we're an institution that is a couple of layers removed from government, that we try, and as the mandate requires us to do, operate purely on commercial principles, try and sort of like identify, investment best practices and implement those. So what does the act actually require us to do? It says that we must try and maximize returns without taking on undue risk. It says, as I said, that we must be prudent and commercial in doing so. It also encourages us to be responsible as well, as we are exercising our obligations. Importantly, it's not prescriptive on what it means to be responsible or what it means to maximize return or what it means to not take undue risks. That's effectively sort of like, the ongoing job of the board and the management of the fund. And conceptions on all of those things certainly do evolve with time as well.
Some things are set in stone, but the interpretation or the outworking of it is kind of left alone so that it can evolve or be reinterpreted in a changing world, right? Like, I guess probably the best example is to invest responsibly. Maybe in 2001 or 2003, when the first investment was made, things like environmental, social, and governance principles weren't widely, maybe not widely adopted and used in managed funds. It certainly wasn't a new concept, but is that just one of the examples of how maybe the interpretation or the outworking of some of that mandate has changed over time?
Absolutely. Certainly, our whole responsible investment framework, which we now call sustainable finance, has evolved dramatically over the past couple of decades. It might have started with a relatively simple exclusions-based framework that these are the kinds of investments that we don't wish to have any exposure to on behalf of the New Zealand taxpayer. Then it sort of like, evolves from that to, well, how do you actually think about climate change risks that might be presented to the portfolio? How do you think about, the ESG risks to the portfolio? Alternatively, how would you think about what contributions your portfolio actually makes to ESG outcomes in the world as well? Over time, this kind of thinking has become an integral, non-negotiable part, I would say, of all of the investment decision making that we do, both at sort of like, the conceptual portfolio design, asset allocation, high level, all the way down to, well, when you select individual investments or you try and identify individual investment products that you might want to be invested in, well, how do all of those macro sustainability considerations filter down?
Mhm.
So yeah, there's a lot
There's
there.
definitely going to be a lot to this, right? So, yeah, like, big pot of money needs to be invested to maximize returns, keep a lid on the risk as much as reasonable, and we have to be prudent, have to be responsible, follow commercial principles, and but not be prescriptive. So there's all these kind of, I guess, rules of thumb or core principles that you need to adhere to, but at the same time, it effectively is as simple as we have a pot of money and we want to make it grow as much as possible, right? And
Absolutely.
that's kind of like how I guess any fund manager would work as well. So apart from the fact that where the money comes from, who's making the contributions is obviously very different with the NZ Super Fund. What are some of the core differences between how the NZ Super Fund operates and how, say, just a large fund manager like a KiwiSaver provider would operate?
One of the main differences really is, we have certain, let's call them endowments, as we might say, because and they kind of like they are granted to us, if you like, simply by virtue of who we are, right, and what we do. What do I mean by that? I mean, for example, that there may be certain rights and responsibilities that we might have as a sovereign investor. So we may potentially be able to get access to certain investments or indeed have certain responsibilities as a sovereign investor. Well, how do we maximize any advantage that we might enjoy on that front? The second thing could be, as I mentioned, we have certainty over liquidity in general terms. We're not going to be paying out or to the crown for at least the next 10 years, and as I said, not in any meaningful large way for another 10 years after that. Okay, so how do we take advantage of the liquidity profile that we have,
Yeah.
and take advantage of those things? So these, I actually think that every investor really needs to think hard about what endowments they might have, what might actually make them different, what makes their investment dollar different to any other investment dollar, and then see whether there might be any advantages that they can sort of like realize from that perspective.
That's really good insight, right? Like what you were saying around liquidity. So some of the investments that the New Zealand Super Fund may wish to make, because they know that they don't need to, I guess, liquidate that money and pay out investors like I say a managed fund would, they can stay risk on, or they can put more money into things that might not have an opportunity to sell in the future. Like, say, for example, forestry, because I know forestry is one of the things that the fund will be investing in. Obviously, you can't just sell some of these trees halfway through because they're not worth anything, right? So
Yeah.
that's probably an example of a liquid. And so you're taking advantage of the fact that you're not going to be called upon to make payments, and you're locking that up, much in the same way that an investor with a 20, 30-year time frame could invest into more volatile stocks, knowing there's going to be ups and downs. It doesn't really matter as long as in the long term it goes upwards and to the right. That's okay, right? So you're taking advantage of what your certain circumstances are, using them to your advantage, and it's just a little bit different because we're talking about a sovereign investor here. It's not a person, but there are unique endowments, like you say. Is that kind of what you're getting at?
I fully agree with you. The two additional points that I might add is one, you want to make sure, of course, that you are getting paid for any illiquidity risk that you are taking on.
Mm,
So we're happy to take that on. It's just we want to make sure that we get paid sufficiently well in terms of excess return for that.
yeah,
So that's one part of it. The second part of it is I would stress that you know despite the fact that it might seem as though liquidity is not an immediate concern because of the lack of withdrawals from the fund, it is actually something that we monitor very closely and try and think about from a whole of portfolio level. And there are reasons for that. One is, we might have certain funding obligations that we have committed to in the future. So we want to make sure that there's always sufficient liquidity at hand or that we can access it sufficiently well. As we know, during times of market crises, the liquidity characteristics of your portfolio can be markedly different. So you want to make sure that you try and understand what the crisis liquidity of your portfolio will look like. And the reason that's important is because you also have certain, overlay programs, highly liquid strategies that you might be running that will require liquidity from time to time, just in order to sustain themselves. The bottom line is we're happy to wear illiquidity. We want to make sure that we're getting paid for it, but we look at it extremely closely as well.
I guess that speaks to the style where I guess when we're looking at traditional fund managers, we're considering, are they an active manager? Are they a passive manager? And I've talked a bit about this on the show, and I was interested to see that it's an active management style with the NZ Super Fund, or mostly active. Can you break down how or what that means in
Yeah.
practice and how that actually works? Like what share of the portfolio is actively managed and what share roughly is just passively indexing away?
Great question, Darcy. And I've certainly heard the New Zealand Super Fund being described as both a passive investor by some people and an active investor by others. So rather than attempting to put a label on it, I think I might just describe
Sure.
our thinking. So the general thinking is that obviously, we have the mandate, as I said, it's a maximize return without taking on undue risk, and it asked us to be prudent and commercial, as I said, in doing so. So our baseline for trying to deliver on that mandate is what we call our reference portfolio, which is 80% global equities, 20% global fixed income. And we think that's a purely passive portfolio. It's a reference portfolio. And we think that even if we did not have any compelling ideas about how the world works or where to generate excess return or any active strategies in our heads, if you like, that reference portfolio will actually help us deliver on the mandate. And it's a very good expression, if you like, of the board's risk appetite when it looks at our mandate as well. What we then try and do is ask ourselves the question, can we actually beat the reference portfolio? And there will be some good ideas we think that where we think we can, and maybe others that don't really cut the mustard. So a lot of our work is spent in trying to evaluate these ideas, trying to see what their risk profile looks like, and then ensuring that they can actually earn their keep in the portfolio.
Okay, so this reference portfolio that you're referring to is kind of like, correct me if I'm wrong, but like that's the benchmark or the model that you're aiming at. Is that how you look at it?
It's many different things. It's certainly that, but it's not the only thing. It's also the board's to the board's mind that this is the correct risk appetite for the fund to deliver on its mandate.
Sure.
Importantly, it's also the cost of capital for everything else that we do,
Sure.
right? So how do we know whether an active investment idea that we have is a good idea or a bad idea? Well, in risk terms, can it actually beat the reference portfolio? How do we know that if we are comparing idea A with idea B, whether we should be invested in A or B, or what proportions we should be allocated to A or B? So having that benchmark that we can risk match to is very helpful for kind of like answering those questions.
Would you be able to just give me some examples though of the private equity investments that are inside the NZ Super Fund?
Yeah, sure. It's also something I would say private equity has been something that's come in and out of the portfolio. I should say we increased and decreased our allocations over time. We have quite a lot of like New Zealand exposures invested in local investment funds, the likes of Direct Capital, Waterman, Pioneer, Movac, and others. And then internationally, we went through a period where we curtailed our exposures quite substantially, but are currently in the midst of a pretty substantial period of work where we are trying to rebuild those exposures as well. One other thing to note is that we have an internal direct team as well. So it's a pretty substantial part of the overall number of investments staff that we have. And they're essentially just sort of like, trying to find directly held assets that either within New Zealand or elsewhere in the world that, that kind of like align with wherever we think we have some
Yeah.
specific insight.
Okay. I want to come back to the portfolio again in a second, but just to take a bit of a break on that, the New Zealand Super Fund, as it relates to other sovereign funds around the world, there's some unique nuances. Like it's a fund that actually does pay tax in New Zealand. These, I understand, are slight differences to other sovereign wealth funds in the world, I believe. But what are some of the main differences between the New Zealand Super Fund and some of the other sovereign funds out there?
So I guess the New Zealand Super Fund is one type of sovereign wealth fund, the less common type, and it's essentially like as we discussed earlier, an intergenerational savings vehicle, right?
Mhm.
The OG sovereign wealth funds, if you like, are the ones from countries that have vast mineral revenues. They're extracting oil or cobalt or copper or whatever, what they're trying to do is ensure they're recognizing the fact that this mineral wealth that is being extracted from the ground belongs essentially to all generations to come, not just to sort of like, the people alive right now. And of course, they're trying to protect their economies as well from, flooding them with vast amounts of resources at the moment, which might be highly inflationary or might lead to, as they call it, Dutch disease, etc. So that's, I would say, one core part of difference, or core angle of difference, which is the New Zealand Super Fund is actually funded from taxpayer contributions, from government contributions.
Mm.
Other sovereign wealth funds are funded really from mineral revenues as well. Other sovereign wealth funds, they can have very different purposes. As I said, ours is really just to maximize the return that we enjoy. Other sovereign wealth funds sometimes help their governments smooth out economic shocks.
Mm.
So during COVID, for example, many sovereign wealth funds paid out to their governments to kind of like help with the fiscal response that governments wanted at that time. The other sovereign wealth funds, in particular, may be tasked with things like ensuring that there is higher employment domestically, or may be tasked with local development investment priorities like infrastructure and so on. Look, all of these are very valid. All of these are very, they are common they are common models around the world. The important thing I would say is having extreme clarity on the actual purpose and how the institution will deliver on its purpose. Because the models that we've kind of like seen fail have been the ones where, you've kind of like set it up with one intention, but maybe directed it to other goals down the road.
So the New Zealand Super Fund, it's an intergenerational savings vehicle, which is taxpayer funded.
Yeah.
But in other countries, and I understand why this isn't the case with New Zealand, just because we're not that person, right? We're not that state where we're not endowed with a lot of natural resources. Yeah, we got wood, that's great, but we don't have like coal, minerals, oil in the ground, or other natural resources which needs to be preserved for future generations. So I think that's really fascinating, though, how again, like kind of like KiwiSaver, right? We've created these vehicles in the past that has set us up really well for the future. These are really positive stories, the New Zealand Super Fund. And it means that we're going to be a lot more resilient in the future and more able to solve problems that demographics will bring upon us. And I think quite often, especially in the last few years, we're quite down on ourselves in New Zealand, not being able to innovate and do better at some things. Maybe we're just a little bit impatient. Maybe we need more leadership, and that's not a consistent thing. Who knows? But it's an 80-20 portfolio. It's a growth portfolio. A lot of people will be familiar with this. So 80% of the portfolio is meant to go higher, 20% there for income stability. But again, going back to that portfolio, 10% of it is alternatives. So can you just break down a little bit about what those alternative investments are?
We've got real estate, we've got infrastructure assets, we've got liquid strategies as well, like hedge funds. We have insurance. We do, catastrophe reinsurance, for example. There is also private equity in the mix. We have some perhaps slightly unusual assets. It might seem like electromagnetic spectrum, which is, something that one can own. So we have exposure to that in the US, and then there are a bunch of other things. Forestry as well as we discussed earlier.
Flavor enhancers, right? Like that's kind of how I've always looked at the more unusual ones, especially electromagnetic spectrum. I never thought about that. So that's effectively owning waves, or sorry, owning a piece of that electromagnetic spectrum with the anticipation that it will be useful for some commercial application in the future. Is that
Yeah,
the idea?
with the anticipation that it might be and be useful for commercial applications now, not necessarily just in the future. For example, a new telecoms operator might wish to set up a 5G network and will require access to the spectrum. Others might wish to lease spectrum off you.
So there are things that the New Zealand Super Fund won't invest in. And what are some of those things? If you can just give me the obvious ones, like no nuclear weapons would be my guess.
Yeah.
What other things will the fund not
No,
touch?
yeah, you're right. So the obvious ones that we take our cues from are things that the New Zealand Parliament has decided are not right for New Zealand. So whether that's whaling or nuclear, so those are a couple of examples there. We certainly try and respect international treaties as well. So look out for sort of like, what UN resolutions might be saying about certain things. So that will help inform. We have certain human rights and labor standards that inform our exclusions as well. And lastly, of course, sanctions, international sanctions. So the point really being that we try not to impose. Certainly, when it comes to this, we try not to impose too much of our own value judgments, if you like. The reason being that, you put a bunch of people in the room, and yes, there will be good alignment on values, but there will not be perfect alignment on values, and there will be, some things that some people think are completely okay, and some things that people think are completely not okay, and that's democracy in action. So what we take our cues from really are from either from the New Zealand government or from international law or from international sanctions and so on.
So there must be some degree of political influence or even social influence that creeps into this sustainable financing corridor, I'll call it, where, yeah, investing according to these certain principles may result in no lower of a return. But in some cases, maybe it gives you a better rate of return if there is a trend worldwide for people to adopt the same principles. Yet, if people then backlash or there's a rejection of those principles, there could be a lower rate of return. And I'm just throwing this out there, kind of spitballing it. But
Yeah.
how much influence is this sustainable finance framework? Is it possible that it could lead to lower returns in the future if there's actually an underlying rejection of some of these principles in the future, just because of societal shifts or even geopolitical shifts?
Gosh, Darcy, there's a lot to unpack in there, so I'm going to try and quickly address a few of the things that you mentioned. First thing, I do want to stress that sustainable finance or modern sustainable investing is a lot more than exclusions. Exclusions are just one pretty small part of it, to be honest. There really is sort of like a heap of thinking on how you actually integrate sustainability more generally into your investment decision making. Right, so that's point one.
Mhm.
Point two is I think the literature, both the academic and the practitioner literature, is probably not quite settled on this front as to whether it makes whether what Whether one loses out, and if so, how much one loses out. Is it actually material or is it not very material? Alternatively, does one stand to gain a lot from investing sustainably? You study the results, you study the literature, you do your research, and you come to some judgment. Our view really is that we believe it is possible to be sustainable and continue to maximize returns and continue to not take undue risk. We think that all of those things are actually possible. One example of that, is since about 2016, so maybe coming up to 8, 9 years now, we've had a climate change related investment strategy that initially again was more exclusions oriented because it tried to turf out exposures to stocks that had high carbon emissions or had high carbon reserves, but has lately become a little bit more directed at solving the direct Paris problem of keeping keeping the world to 1.5 degrees. There's a lot, I guess, that we can talk about here as well.
Yeah. I want to kind of just finish up on talking about the performance because I had a look at the numbers before. 9.9%, I think, was the returns over, correct me if I'm wrong, but over the last 20 years before tax, after fees. So what else can you tell me about the performance of the fund? Because it has exceeded that of its benchmark, right? Like it is doing better than average, which clearly shows that what you're doing is good. It's getting the job done. What else can you tell me about the performance and looking forward? Do you still have as much confidence that that same amount of performance could be achievable?
There's a couple of things I could say. I would say that probably one of the reasons that we have been able to enjoy the performance that we have has been because of the very, very strong governance arrangements that exist around the fund, the independence of its decision making, the idea of this competition for capital where investments are directed wherever we think they'll earn the highest risk-adjusted return, the investment beliefs that we hold that asset prices will mean revert over time. So which means that one can actually undergo periods of very substantial loss, but one can design programs that can help you see through that, that can see you through that, I should say. So yeah, the governance is integral to the performance. The second thing is, of course, is that by virtue of this very long-term mandate that we have, we've been able to take on a lot of risk. Because we've taken on a lot of risk, we've been able to generate a high return as well in the past. We talk about this 80/20 portfolio, and effectively what that means is that we are loading up on equity markets beta, as they say, probably for the period of time that we have been invested. It has been, in speaking in very broad brush, a very good time for equities. There is a risk that we may undergo, a decade-long period, let's say, when equities solidly underperform. In that case, I think, one cannot expect future performance to stay as past performance has been. But overall, I think the recognition really is that, we are trying to set up this fund to invest as for, many, many decades to come. So you try and sort of like think about what equilibrium expected returns might be from various asset classes and then, try and construct a portfolio on that basis.
That's a good answer. Okay. Now I have to ask this question because I just think it's just so important, and we'll finish up with this one. So Larry Fink, heading up biggest fund manager in the world, BlackRock, is starting to fall in line with a lot of the other fund managers like Fidelity who are doing this. A small allocation towards Bitcoin, according to a lot of research that I'm seeing across my desk lately, suggests that you can increase performance without dramatically increasing the risk. To me, it kind of sounds like a no-brainer. Would you ever see the New Zealand Superannuation Fund getting into a very small allocation of Bitcoin?
I cannot discount it. There is no doubt that it is receiving increasing legitimacy in institutional portfolios as an asset class. We have a research program on Bitcoin, or I should say on crypto, underway. So there are, a few people who have been looking at this for, several months, if not a couple of years now.
Okay.
And there will come a time, I think, when, we will have to make a decision about its place in the portfolio. But there's no real reason, I would say, at this stage why it can't earn a place in the portfolio.
Okay. Well, I'll take that as a yes, Rashad. That's great. Okay. I put those words in your mouth, not yours. Awesome. Well, thank you very much for your time today. I really appreciate you having this chat with me. It's the first time I've kind of reached out to the New Zealand Super Fund to have this conversation. So thank you for being so accommodating to my questions today.
Of
Appreciate
course.
that and enjoy the rest of your week.
Thanks, Darcy. Take care.
Thank you. Cheers.
Bye.